Good morning, everyone. Your Excellencies, ladies and gentlemen, I'm Michael Lawrence. Welcome to Asia House. And today our focus is the Asian Development Outlook for 2019 from the Asia Development Bank. This is the third or fourth year in a row the ADB has kindly brought this report to us to brief our stakeholders, and we're very grateful to them for that. The key finding of this latest report is that growth in developing Asia will slow this year and next. The ADB has cited two major risks: the trade dispute between the US and China and the potential for a disorderly Brexit. Specifically, the report finds that developing Asia's growth will slow to 5.7% in 2019 and 5.6% in 2020. By way of context, 5.6% would be the lowest growth rate since 2001. It also finds that growth in China will slow. The ADB has maintained its forecast for this year, 6.3%, but lowered it a little. It'll slip to 6.1% in 2020. And on the upside, there are some pockets of stronger growth, particularly India, where consumption-led growth will show a reasonable increase. The ADB says that overall, though, the risks remain, and I quote, tilted to the downside. The greatest risk is a prolonged US-China trade dispute. While the impact of the trade tensions thus far has been small, any escalation, the ADB says, would present a substantial risk to developing Asia. Other risks highlighted by the ADB include growth in the advanced economies, and China may slow more than anticipated. And while there now appears less chance of aggressive rate hikes by the Fed, market volatility is still a risk, and policymakers need to remain vigilant. In a moment, we'll get a full briefing on the report from Abdul Abiad, who's Director of the Macroeconomic Research Division at the Asian Development Bank, who's very kindly flown in from Manila to brief us today. Welcome, and thank you very much. And after that, we're going to broaden it out into a panel discussion, and Abdul will take part in that as well. As usual, very much welcome your involvement, your questions, your comments, so please take part. With that, a very warm welcome to Abdul Abiad.
Thank you very much, Michael. Pleasure to be here at Asia House, and this is actually my first stop in terms of doing outreach for this report. Let me clarify the title there. It says Strengthening Disaster Resilience. It's not that we're expecting an economic disaster. We have a theme chapter in the report which talks about disasters relating to natural hazards, but that's not what I'm going to talk to you about here. Okay, so there'll be two parts to my presentation. One is I will talk about the outlook and risks for developing Asia, as Michael mentioned, but the second part, I'll go in a bit more detail into the trade conflict and what it means, not just for developing Asia and the two main protagonists, but also for more broadly for the globe. So let me proceed now to the outlook and risks. Let me summarize, first of all, the key messages, which were already mentioned. The first is that developing Asia has already started slowing last year and is expected to slow this year and next, primarily because of weaker global demand, but also prolonged trade tensions. Second main message is that the two largest economies, the People's Republic of China, well, PRC, and India are on sort of divergent growth paths. PRC is expected to slow, and India's growth is expected to pick up. Third key message, inflation in the region is expected to remain low and stable at about 2.5% this year and next, same as it was last year. And the fourth is about the risks that were already mentioned. And in our view, the primary risk still centers on the trade conflict, and there are various ways this can play out. I'll talk a bit more about that later. Okay, so developing Asia's growth is softening, as we said, and a big part, so you can see that in the right-hand side chart. The blue line shows growth in developing Asia slowing from 5.9% last year. That was already a slowdown, and slowing down further this year to 5.7% and 5.6% next year. The red line just shows you what the growth rates would be if we excluded the newly industrialized economies. The right-hand side table basically shows one of those key factors, that basically the external environment is weakening. We forecast that The major industrial economies, the US, the Euro area, and Japan, are slowing, and that will obviously weigh on Asia. Here's another way to look at that. This chart shows purchasing manager indices, both manufacturing in blue and the composite PMI in red. And you can see that there was a strong pickup. Remember, 2017 was a good year. We saw an acceleration in growth, and that continued into early 2018. But through the course of 2018, you saw global activity slowing by this metric, and similarly, you see a similar pattern in world trade, strengthening to 2017 and through most of 2018, and then coming down in the latter half of 2018. You already see the impacts of that in developing Asia's trade. So you have exports of both commodities and primary products and manufactured products on the left chart, and imports, and you basically see the same pattern, where a strengthening and then a weakening toward the end of last year. Now, we should emphasize that despite the slowdown, Asia's growth still remains robust. And the reason for that is that despite this weakening in the external environment, domestic demand in the region remains strong. So the blue bars here show the contribution of net exports. Sorry, the dots are GDP growth in each country in 2017 and 2018. And you can see that the contribution of net exports, or the external factors, is negative for many countries. So we focus here on 11 of the larger economies in the region, and for 7 out of these 11, the blue bars are negative. So the external sector was a drag on growth. But if you look at domestic demand, which is composed of consumption, the orange bars, and investment, the gray bars, you can see that both of those not only remain strong, in many countries there was actually a pickup in consumption growth, in the contribution of consumption to overall growth. And also for investment, it's more of a mixed picture. You see some countries, such as Indonesia, the Philippines, and Thailand, where the gray bar, the contribution of investment went up last year, whereas for other countries like Malaysia and Korea, the gray bar, the contribution of investment declined. But overall message is that domestic demand has really remained strong in the region, and we also expect that to continue. So here's an overview of all our forecasts, and the arrows in the table show how growth has changed relative to the previous year. So these are not the revisions, but just so you can easily see which countries are slowing down relative to last year and which are speeding up. And as you can see, there are many more red arrows than green arrows. And in particular, the more open subregions of East Asia and Southeast Asia on the left, you see the effects of the external weakening. You see a lot of growth moderation in these countries. East Asia obviously very tightly linked to the People's Republic of China. Southeast Asian economies also pretty open. The one exception is the Philippines, where a strong public investment push is keeping growth up. Southeast Asia is actually a bright spot in the region. Growth is actually going to pick up. It's a relatively more closed region, and you do have very strong growth, not just in India, where growth is picking up. We expect growth to pick up to 7.2% and 7.3% this year and next. But Bangladesh, for example, where we are expecting growth to hit 8% in both years. So let me talk in a bit more detail now about the PRC and India. So for the PRC, again, yes, growth is slowing down. 6% is still the kind of growth rate that many countries would love to have. And again, many of the factors behind the slowdown are actually structural in nature. You have the process of convergence. The richer you get, the slower you tend to grow. We know that China's population is aging, and there's also this structural shift away from investment toward consumption and away from industry and toward services. All of these would suggest that growth should naturally slow. And that's what you see here on the right-hand side. So industry is the contribution here in blue, and you see that's been declining over the past years. This is services. Contribution of services has been rising, but this takes time, and so what you will tend to see is sort of a moderation in growth. The right-hand side chart shows that it's not all structural. There's another cause of the slowdown is policy tightening, in our view, appropriate policy tightening to head off financial risks. So in this case, in the chart here, basically, the green line shows the growth of shadow banking. So the unregulated lending, that picked up sharply in 2017 through early 2018. And since then, the authorities have really clamped down on that, and you're now seeing a contraction. And that is contributing to a slowdown in overall credit growth as measured by the red line, total social financing. So bottom line, in the PRC, a gradual slowing in growth to what we view as more sustainable rates. If you turn into India, what we expect to see over this year and next is a slight uptick in growth. It was already strong last year, but we expect growth to pick up slightly to 7.2 and 7.3%, in part because of supportive policies, policy rate cuts plus rural income support. And again, a lot of, if you look at sentiment indicators, for example, for India, consumer and business sentiment remains strong. The chart on the right shows PMIs sort of on an upward trend, well in expansionary territory. Inflation in the region, there's not too much of a story here. It picked up slightly last year because of oil prices on average being higher in 2018 relative to 2017, and also currency depreciation in many of the region's economies. If you look at the forecast period, we expect oil prices to be relatively stable and food prices to inch up only slightly in 2020. And so inflation as a whole, we expect to remain at 2.5% this year and next, same as last year. And that's well below the 10-year historical average of 3.2%. Okay, and in terms of the risks, as mentioned, we see the greatest risk as centering around the trade tensions between the US and the PRC. And there are various ways that this can play out. I will talk about that in the coming slides. The other risks that were already mentioned are the possibility that you get a sharper than expected slowdown in the advanced economies, possibly triggered, for example, by a disorderly Brexit, or by, let's say, fiscal policy uncertainty in the US. The third bullet here basically just mentions that last year we were concerned about the potential for faster than expected Fed rate hikes. We now see that as being less likely. You all know that the Fed has sort of taken a pause. What we highlight in the report is that there's still the risk of financial volatility, because basically what's happened now is that uncertainty regarding the trajectory of US monetary policy has increased. And as we show in the report, periods of high US monetary policy uncertainty are associated with greater exchange rate volatility in developing Asia. So let me turn now to the trade conflict and its implications. So I'm sure most of you are familiar, for those of you who follow Asia, with the chronology, but let me just walk you very quickly through it. This basically shows you the chronology of trade measures taken since last year. I know the text is a bit small, so I'll just walk you through it. In the first quarter of last year, that's really when the trade conflict started. And it really started not as a bilateral trade conflict, but one of the US imposing tariffs on solar panels, washing machines, steel and aluminum, not just on China, but on a wide range of countries. And many of these countries retaliated. That's the green bar over here. So the US tariffs hit about $58 billion worth of goods. Retaliatory tariffs hit about $36 billion worth of US exports. The trade conflict really morphed in the second and third quarter of last year, when it became more bilateral in nature. And it started with the US imposing about $50 billion worth of tariffs over the course of July and August, to which China retaliated tit for tat. And then the US raising the stakes substantially by imposing tariffs on $200 billion worth of Chinese exports. to which the PRC retaliated with $60 billion worth of its own tariffs. If you're wondering about the smaller amount, that's basically the most it could do, because China only China only imports about $130 billion worth of goods from the US. And so in addition, what we had last year was the threat of even more to come, and that there were several components to that. The US actually went forward with the vetting of an additional $267 billion in tariffs, which would effectively cover all of PRC exports to the US, to which the PRC said it would retaliate, but without specifying exactly what that would look like. The US also went forward with the possibility, with the initial steps toward imposing tariffs on autos and auto parts, and that again would be more global in nature. And many countries, including here in Europe, basically said they would retaliate to the tune of about $300 billion. So this was obviously very important for developing Asia, and many policymakers were asking us, what does this mean for the region? And it's a big concern. It shouldn't be surprising. The US and the PRC together account for about 40% of the global economy and about a quarter of world trade. The chart here, this diagram here, basically shows global value chains. The size of the dots show the extent of participation, and the thickness of the lines indicate the strength of linkages between countries. I know it's a bit too small to read, but you basically have three main global manufacturing hubs in Germany, the US, and the PRC. And as you can see, again, these two are central to these global manufacturing chains. And so an escalated trade conflict could potentially disrupt these our trade patterns. So what we wanted to do to help was, I'm sure you've all read a lot of analysis on what the trade conflict might mean, but a lot of these are done either at the global or at the regional level. And many countries in Asia were asking, what does it mean for my country? What does it mean for sectors within our country? And so that's what we sought out to do, to look at impact not just at the global and regional level, but also at the country and sector level. And we looked at three channels. There are many ways that this conflict can affect economies, but one is obviously through the direct impact of the tariffs. A second is through indirect channels. So if you sell intermediate goods to a country that's impacted by tariffs, then you can get hit indirectly. And a third thing we look at is the possibility of trade and production redirection toward other countries or suppliers that are not hit by tariffs. So those are the things we looked at in our analysis, and we looked at three possible scenarios. One is the current scenario, which incorporates all the tariffs that have been implemented as of now. A bilateral escalation scenario where all bilateral trade between the US and PRC is hit by 25% tariff rates. And a worst case scenario where on top of that you add a 25% tariff on all auto parts. Just wanted to say also, I'm happy to share these slides so you don't have to take pictures, but feel free to do so if you want. We're able to look at the impact on individual countries and sectors within countries because we have a very rich data set. It's called the multi-regional input-output table that goes up to 2017. We're actually updating it to 2018 now. It covers the whole economy in 62 countries, so where the economy is broken up into 35 sectors. So we capture about, this data set covers about 90% of world GDP and 24 economies in developing Asia. There's a link to the data set, because I won't be able to show you all the results, but if you go to this link, you can download the tool that will allow you to look at impacts on specific countries and sectors within these countries. So let me walk you through the main results. Globally, the effect is actually pretty small. Again, through these three channels, big caveat, the effects of the global trade conflict through confidence channels is very hard to quantify. We don't attempt it. You can look at the analysis, let's say, by the IMF that does that. But so the chart on the left basically shows the impact of just the direct and indirect channels. So the direct effect of tariffs plus the indirect effect through production linkages. no trade redirection, and the right chart adds on trade redirection. The blue bars basically show the effect of the current scenario. So under the current scenario, the impact on the global economy is small, and a half of a tenth of a percentage point if you have trade redirection, or without any trade redirection, it's about a tenth of a percentage point. Not a big deal. Should the trade conflict escalate bilaterally, that would be an additional drag of 0.2 percentage points. And if the conflict in autos and auto parts is added to that, you get an impact on the global economy of about 0.5% relative to a no trade conflict scenario. If there is trade redirection, that actually attenuates the effect on the global economy. Now, most of the effect on the global economy is actually felt by the two protagonists. So the PRC and the US are the two countries most negatively affected, with the PRC hit harder because the tariffs that the US is threatening to impose in a bilateral scenario are substantially bigger and more important to the PRC economy. So under the current scenario, the impact on the PRC economy is about 0.25 percentage point relative to no conflict. If things should escalate, you see that adds about 0.75 percentage point. So all in all, you could see should bilateral escalation happen, it would shave about 1% of Chinese GDP. Remember that this could take place over several years. It's not all in 1 year. Nevertheless, it's a non-trivial impact. The impact on the US is about 0.61 if there's no trade redirection, a smaller 0.25 percentage point if there is trade redirection. Basically, what happens is that your domestic suppliers do benefit from the protection, but still the effect is negative on the US. And if we talk about the impact on others, both, let's say, we have here the G3. Again, there's a further breakdown of this on, let's say, individual European economies. And here's the effect on individual developing Asian economies. The bars look small because they are small. So in most of these, the impact is, a few tenths of a percentage point, if that. I think on average it's a tenth of a percentage point. So these are the effects primarily through these production linkages. So we were actually surprised. Again, the general sentiment was, well, we sell a lot to China. Isn't the impact going to be big on us? When you actually quantify it, the impact is not that large. In addition, when you allow for the possibility of trade redirection, the net effect could actually be positive. We stress in the report that trade redirection is not automatic nor guaranteed. It depends on how well a country is able to attract customers or production, or if production can move. So, but bottom line is that with or without trade redirection, there's actually not that big an impact on the rest of developing Asia. If the trade conflict were to escalate, there are actually potential, again, significant gains to some countries in the region, in particular to Vietnam, Malaysia, and Taipei, China, where, again, these are countries which produce a lot of goods that are similar to what that compete directly with what China currently produces and that might be subject to tariffs. The last thing we look at is, so the risk of escalation is still there, but our assessment of that has declined somewhat relative to last year, basically because the two sides are now negotiating. There's a different risk that we identify in this report, which is the risk of protracted negotiations and the uncertainty that produces. So there's actually a way you can measure the trade policy uncertainty. There are metrics based on it's big data and news-based counts of the mentions of trade policy uncertainty. These were developed a few years ago. And so if you look at just the US trade policy uncertainty, what you see is that, again, so this is a news-based measure. We look at that over the past 25 years. And what you see is that this escalated a lot in the early 90s. This was NAFTA. This was prior to NAFTA. And then it fell back down. But you see a very clear increase, basically since 2017, and then further in 2018. And so obviously this is just US trade policy uncertainty. What does it, may not have to do directly with Asia. So what we did was we refined this measure to look at US trade policy vis-a-vis Asia. And if you refine the measure that way, what you see is a similar pattern, but basically the measure is now at all-time highs. You can also construct similar measures for individual Asian economies, which we do. Here's the chart for China, for example. And what you see is that trade policy uncertainty in the PRC was high in the mid-1990s when you had, bilateral trade tensions over intellectual property rights. It was also elevated in the late 90s and early 2000s during the time that China was joining the WTO. Then it sort of stayed low, and as you can see, it sort of spiked up now, and is again at all-time highs. Why does this matter? Well, uncertainty in general, of which trade policy uncertainty is one variant, obviously affects investment and economic activity because investment, it depends on what you think about the future, and in uncertain environments, you might tend to delay these investments. And in fact, what we do in the report is actually look at whether there are measurable effects of spikes in trade policy uncertainty. And in the case of the PRC, for example, when we looked at periods where trade policy uncertainty was high, this shaved about 1% off investment over a period of 3 quarters. Eventually, when the uncertainty resolves itself, there's no significant effect. But the point is that you can have a delay in investment because of trade policy uncertainty. So let me just recap key messages again. Developing Asia is expected to slow this year and next. PRC is slowing down. Indian growth is picking up. Inflation remains subdued. And the primary risk centers around the trade conflict, with uncertainty being heightened by the protracted negotiations. And so let me end my presentation there. Thank you very much.